Finding an EV SPAC that trades below $15 is a very rare find these days. I will tell you about a SPAC which is merging with a company that has an EV production plant ready to go and 30,000 pre-orders for its vehicles. On top of that, the merger target is the only entrant in the Class 1 commercial EV market. The Class 1 commercial trucks support the expected 1 trillion North American e-commerce market by 2025. FIII Merger III Corporation, NASDAQ ticker symbol FIII, there are 3 I's after the F, is a publicly traded special purpose acquisition company with $250 million in trust. This SPAC has filed a letter of intent to merge with Electric Last Mile Solutions. This company combined will be listed on the NASDAQ under the ticker symbol ELMS. FIII Merger III Corporation is led by financiers with a proven track record. Their most recent SPAC deal was a merger of FIII Merger II Corporation with plant-based food company Tattooed Chef. This SPAC deal gave a return of 250% to the SPAC investors. In this video, we will take a deep dive analysis of the company background and the product offerings of Electric Last Mile Solutions. This deal is a bit unique. There are 2 different companies that are coming together to merge into one single entity. The first company is the manufacturer of the top-selling electric vehicle vans in China in 2020. The other company has provided Electric Last Mile with a production-ready EV plant in Mishawaka, Indiana. We will also take a look at the merger transaction details and the share structure of the new company. Finally, we will try to come up with a valuation of a bull case scenario and a conservative estimation of the Electric Last Mile Solutions. So please stay until the end to find all the details about this rare undervalued SPAC. Hi, I'm Arshad Ahmed, founder of DIYstockpicker.com, an investment portal dedicated to help investors make intelligent decisions. This video is for information purposes and please do your due diligence before making any investment decisions. I have started a Patreon page where I'm sharing my IRA portfolio that has generated me 90% returns. I have put the link in the description and I hope you'll join the Patreon family. So let's get started. Founder and CEO of Electric Last Mile Solutions is James Taylor. Mr. Taylor has served more than 30 years at General Motors as the president of Cadillac and the CEO of Hummer. He was also the chairman and CEO of Workhorse. The executive chairman is the former CEO of Key Safety Systems that has recently been renamed Joyson Safety Systems. This is a massive company competing in the automotive safety equipment space. Thus, Electric Last Mile is led by industry veterans who have deep connections with OEMs both in North America and China. As I mentioned earlier, the Electric Last Mile Solutions deal involves 2 companies that are coming together with their assets and putting it in a publicly traded SPAC, FIII Merger III Corporation. Electric Last Mile Solutions will be completely based in the United States with its manufacturing plant in Indiana, and it will be employing American workers. We will take a look at the 2 companies that are involved in the transaction. The first company is Socon, based in China. This company is listed on the Shanghai Exchange. Socon is the manufacturer and has sold more than 35,000 EC35 electric vehicle vans in China. The EC35 electric van is the top-selling commercial van in China. Socon brings the following benefits to the table: the engineering program in place to meet regulatory requirements, provide the body production parts, domestic supply of EV powertrain products from global suppliers, with long-term battery supply from CATL. CATL is also the battery supplier for Tesla. The second company is Ceres, based in Santa Clara, California. The company was formed to develop electric powertrains and software. Ceres invested $130 million in the Indiana Mishawaka factory. It bought the plant from GM and fitted it for EV production. The powertrain manufacturer brings the following benefits to the table: 100,000 capacity production-ready plant that has recently produced the Hummer for GM and the Mercedes R-Class vehicles, experienced automotive and software team, license to the EV technology and over-the-air patent portfolio. The prototype van has already been built at the plant. This is what differentiates Electric Last Mile from other SPAC players. The company has a product, the electric van, which is being driven for 1.4 million miles daily in China, and an industrial plant that is ready for production. Let's take a look at the product offerings. Electric Last Mile is strategically positioning their entry in the commercial EV market across 3 different classes. The company is targeting the Class 1 through Class 3 of the commercial EV market. It has 2 products, the commercial delivery vehicle and the commercial utility vehicle. The urban delivery vehicle is the only EV offering in the Class 1 segment. It is expected to cost the same as a gas delivery vehicle, which is really the icing on the cake. There is no competitor inside and it is the lowest cost provider. What else can you ask for? The delivery vehicle is expected to offer 30% more cargo space and 35% savings on the total cost of ownership than the leading Class 1 provider. The urban utility vehicle is in the Class 2 and Class 3 segment of commercial vehicles. This vehicle will be competing with OEMs like GM and Ford and the new EV offerings in the pipeline like Rivian and Workhorse. The management has come up with a capital efficient business model. Management estimates the cost to build and launch a new vehicle, including the plant in the North American market from scratch, would be $1.6 billion. SoCon has already put an estimate of $570 million in building the EC35 electric vehicle, which would be electric last miles EV vehicle in the United States. Ceres estimates over $130 million invested in the plant, including the work already done to adapt the plant for EVs. So at a fraction of a cost of about $160 million, the electric van can be launched, giving electric last mile a huge advantage over other EV players in the commercial market. Let's take a look at the delivery market and the use cases. The last mile vehicles take the goods from the distribution warehouses to the customer. This is usually the most expensive segment of the e-commerce supply chain. Electric last mile plans to reduce the total cost of ownership by 35%. This is by providing more cargo space and reducing the maintenance and fuel costs. Electric last mile is ready to deliver the first electric vehicle in the third quarter of 2021, which is really round the corner. Electric last mile has over-the-air systems and a strategic partnership with GeoTab to deliver digital solutions to fleet customers. The current commercial vehicle manufacturing process is in two stages. The OEMs provide the base body and the upfitters fit the custom body on top of the base vehicle. This results in a delay of the delivery of the vehicle because there are different players involved in the manufacturing process. Electric last mile has integrated this process into one. The upfitting is available in the production plant itself. This reduces the time to delivery by 25%. Approximately 30,000 pre-orders are in hand or in process, and customers include some of the largest fleet operators around. This includes companies like IKEA, Best Buy, Walmart, FedEx, and Disney. Let's take a look at the merger transaction details. Pro forma implied equity value of approximately $1.196 billion. $379 million cash to balance sheet to fund the growth. The company plans to use this cash to expand into the European, Canadian, and the Mexico markets. Transaction includes $250 million of cash held in trust and an immediate $155 million financing through a fully committed PIPE. The deal is expected to close in the first quarter of 2021. Let's take a look at the share structure. Total shares outstanding of 142.5 million, 66.7% existing electric last mile shareholders, 17.6% Forum Merger III public shareholders, 4.8% Forum Merger III sponsor shareholders, 10.9% PIPE investors. Now let's try to come up with a valuation for electric last mile. The company is operating in two main segments, the urban delivery segment and the urban utility segment. The company conservatively estimates that it will be able to capture 5% of these markets by 2025. The urban delivery segment is expected to grow at a compound rate of 13% from 633,000 vehicles sold in 2021 to 1 billion in 2025. On the other hand, the urban utility segment is expected to grow at a compound rate of 8% from 378,000 vehicles sold in 2021 to 476,000 vehicles sold in 2025. Electric last mile expects to sell 83,000 units by 2025, representing about 5% of the US market. This translates to a revenue of $3 billion and an EBITDA of $791 million by the end of 2025. Let's take a look at the bull case valuation. $3 billion in revenue and an EBITDA of $791 million by the end of 2025. We'll use a valuation multiple of 5. That gives an enterprise value of $15 billion. Divide $15 billion enterprise value by 142.5 million shares outstanding. This gives a valuation of $105 per share in 2025 estimated. Let's try to come up with a conservative valuation. For this valuation, we will use a 3% market penetration rate instead of 5%. This will translate to 35,000 vehicles sold by 2025, which will result in a $1.177 billion revenue and $248 million EBITDA expected by 2025. We'll again use a valuation multiple of 5 that gives a $5.885 billion valuation. Divide $5.885 billion valuation by the 142.5 million shares outstanding. That gives a valuation of $41 per share in 2025 estimated. There are a few risk factors involved in investing in electric last mile. First is the company is trying to be vertically integrated by being an OEM and an upfitter at the same time. As the production ramps up, it will be interesting to see how many use cases the company will be able to accommodate. The Class 1 delivery vehicles has different upfitting scenarios. It would have been better if it chose an upfitting partner nearby in Indiana where it could offload the upfitting work. The Class 1 electric vehicle market is not crowded, but the Class 3 vehicle market is definitely crowded. Electric last mile will be competing with experienced players like Workhorse and Rivian in the Class 3 market. If it wants to downgrade and sell in the Class 2 market, it will run into OEMs like Ford and GM who are coming up with their own electric offerings. There is always the risk of the SPAC merger not going through. However, at this price point, I think it's worth taking the risk. I think the management clearly knows the advantage they have in the EV market. They have a production van that is being sold in China and is among the top selling vans. And they have a production plant ready that has been fitted for EV production. This takes away a lot of capital expenditures and the startup costs. They can produce an electric vehicle at the cost of a gas vehicle after tax credits. This reduces the total cost of ownership for fleet owners. And moreover, this is the only EV offering in the Class 1 segment. I think electric last mile is a rare jewel and an undervalued SPAC that can be grabbed before the market pays attention. I hope you found this video informational. I have analyzed the Canoo electric vehicle stock and you should see it here on the end screen, and I hope to see you in that video. Take care. Bye.